You know, every single day, the money sitting in your bank account is quietly losing its value. This isn't some dramatic crash you see on the news. It's a silent crisis, a slow and steady bleed that is secretly shrinking your savings. This is being driven by a couple of powerful forces here in 2026: stubborn inflation and a declining dollar. For most people, this is a recipe for anxiety. It's that feeling like you're working harder just to stay in the same place, and your financial goals seem to be drifting further and further away. But here's the thing. While most people are watching their savings shrink, the wealthy are making a series of simple, calculated moves. They are turning this very threat into what could be a massive wealth-building opportunity. In this video, I'm going to show you exactly what smart money is doing. We'll break down the two core problems facing your cash, and then I'll reveal the three-part stock market playbook the rich are using right now to not just protect their wealth, but to actually grow it in this environment. Let's start with the first and most damaging problem: inflation. Now, if you look at the numbers, you might be tempted to relax. The annual inflation rate in the U.S. did slow to 2.4% in early 2026, which is getting closer to the Federal Reserve's 2% target. But the consensus view that inflation will just fade away might be a little too optimistic. In fact, some economists are warning that powerful forces brewing under the surface could push inflation higher again, with some analyses suggesting it could even rise past 4% by the end of the year. So, what's really going on here? This isn't random. There are three key drivers to watch. First, we have an incredibly tight labor market. Changes in policy are creating labor shortages in critical sectors. When companies have to pay more for workers, where do you think those costs eventually go? They get passed on to you, the consumer. Second, government spending is running red hot. The fiscal deficit, that's the gap between what the government spends and what it brings in, could top 7% of the entire country's economic output this year. This pumps a ton of money into the economy, creating more demand for a limited supply of goods and services. That's a classic recipe for inflation. And third, the delayed effects of tariffs are finally starting to hit our wallets. For a while, importers were eating these extra costs, but their old, cheaper inventory has run out. Now, they're passing those costs on. By the middle of 2026, this alone could add as much as half a percentage point to headline inflation. So what does this actually mean for your money? Let's make it real. Imagine you have $100,000 saved up, earning next to nothing in a bank account. If inflation just hangs around at a seemingly modest 3%, in 5 years, the purchasing power of that $100,000 will have dropped to about $86,000. You haven't spent a dime, but you've lost $14,000. It's an invisible tax that punishes savers. This is the silent crisis happening in every single savings account across the country. As if that invisible inflation tax wasn't bad enough, your cash is facing a second major headwind in 2026, a weakening U.S. dollar. Now, this isn't some doomsday prediction. It's a cyclical downturn that many mainstream analysts see on the horizon. While geopolitical events can cause the dollar to strengthen in the short term, the broader view from many analysts is that the dollar will weaken later in the year. Research from Morgan Stanley, for instance, suggests the U.S. dollar index could fall from around 100 down to 94 in the second quarter of 2026 before rebounding later in the year. The big question is, why is this happening? A primary reason is the expected direction of interest rates. Many expect the Federal Reserve to cut interest rates in 2026. When the interest paid on U.S. assets falls, it becomes less attractive for international investors to hold dollars. So they sell them, and the currency's value goes down. At the same time, the U.S. is running what's known as twin deficits. a budget deficit, which we just talked about, and a trade deficit, which means we buy more from the world than we sell to it. To fund this, we need a constant flow of foreign money. But as rate cuts make the dollar less attractive, that flow of capital can slow down, putting even more pressure on the currency. A weaker dollar hits your wallet directly. Anything you buy that's imported, from phones to cars to even some foods, gets more expensive. It acts like another layer of inflation, chipping away at the value of every dollar in your bank account. So you're getting squeezed from two sides. Inflation is eating your domestic purchasing power, while a weaker dollar eats your global purchasing power. Holding cash in this environment is like trying to carry water in a leaky bucket. Okay, now that you get the dual threats to your cash, you might be feeling a little anxious. But don't panic. This is where the script flips. Smart money doesn't see this as a time to hide. They see it as a time to reallocate. They're moving out of assets that are guaranteed to lose value, like cash, and into assets that are positioned to thrive. The core of their strategy? It revolves around the stock market. So let's break down the three simple yet powerful stock market moves the wealthy are making in 2026. The first and most fundamental principle is that over the long term, stocks have historically been one of the best ways to beat inflation. Think about it like this. Holding cash is like holding a melting ice cube. It is guaranteed to shrink. But investing in high-quality businesses is like owning a growing tree. When prices rise, many strong companies can just pass those higher costs on to their customers, protecting their profits. Plus, inflation often happens in a growing economy with high demand, the exact environment where great businesses can boost their sales and earnings. While Wall Street expects a more volatile year, the backdrop of a resilient economy means stocks can continue to do well. This is all about getting a real return. A real return is your investment gain after you subtract inflation. If your stocks go up 7% and inflation is 3%, your real return is 4%. You're actually growing your purchasing power. But if your cash earns 1% and inflation is 3%, your real return is negative 2%. You are guaranteed to be getting poorer. Smart money understands this basic math and simply refuses to play a losing game. Now, this move might seem a little backward at first, but it's a classic strategy of sophisticated investors. While a weak dollar hurts you when you buy imported goods, it can be a massive tailwind for certain types of companies. Which ones? We're talking about large, U.S.-based multinational corporations. Think of the biggest names in tech, consumer goods, and healthcare that sell their products all over the world. Here's how it works. When these companies sell their software, their phones, or their sodas in Europe, they get paid in euros. When they sell in Japan, they earn yen. When the U.S. dollar gets weaker, every single one of those euros and yen translates back into more dollars on their financial statements. It's a pure currency-driven boost to their profits, on top of their regular business growth. Their earnings per share go up, which makes their stock more attractive. A weaker dollar, which is a problem for cash hoarders, becomes a direct profit driver for shareholders of these global giants. In 2026, smart money is actively looking for these kinds of companies with major international sales. Finally, smart money isn't just buying the whole market blindly. They are aiming their capital at sectors with powerful long-term growth trends that are bigger than any short-term economic noise. For 2026, two themes are standing out: artificial intelligence and resilient global growth. First, AI. You've heard the bubble talk. But the simple fact is that companies and governments are pouring historic amounts of money into AI infrastructure. This is fueling a supercycle of investment and productivity that is just getting started. While the obvious plays are the chip makers, smart money is also looking downstream at the software and e-commerce companies that will use AI to supercharge their own profits. Second, they're investing in resilient companies against a backdrop of sturdy global growth. Analysts from major firms like J.P. Morgan and Goldman Sachs are positive on global equities, pointing to strong earnings growth and supportive policies. They're looking for companies with solid balance sheets and the ability to grow their earnings even if the economy hits a few speed bumps. The focus is on quality and durability. The key takeaway here is to invest in the direction of progress. While the daily headlines are designed to create fear, these underlying trends of technological innovation and global expansion are incredibly powerful. Smart money finds the best-run companies leading these trends and invests for the long haul. So, what's the bottom line? The financial landscape of 2026 presents a clear and present danger to anyone holding their wealth in cash. The 1-2 punch of sticky inflation and a weak dollar is creating a silent erosion of your savings. But as we've seen, this is not a time to be hopeless. It is a moment of decision. You can do what most people do and just watch as the value of your hard-earned money slowly melts away. Or you can follow the smart money. You can understand that in this environment, owning a piece of great businesses isn't just for growth. It's a necessary defense. The strategy is clear. Invest in high-quality companies that can outpace inflation, benefit from a weaker U.S. dollar, and are leaders in unstoppable trends like artificial intelligence. The system is not set up for savers to win. It's set up for investors to win. The choice is yours. Watch your wealth shrink or start making the moves that turn this crisis into your greatest opportunity.